Hey everyone, welcome. You're not just imagining it. It feels like everywhere you look, people are talking about IPOs again. We're going to dive deep into the analysis from Barron's to figure out what's going on, why it's happening now, and what it all means for you.
And that's the headline right there. It's from a recent Barron's cover story, and it pretty much nails the vibe on Wall Street. After a couple of pretty sleepy years, the market for initial public offerings, IPOs, is back and booming in 2025.
And I'm not kidding when I say booming. To give you a taste of the kind of wild potential we're talking about, a recent IPO for a company called Voyager Technologies saw its stock jump a mind-blowing 735% on its first day of trading. Yeah, numbers like that, they tend to make people sit up and pay attention. All right, so here's what we're going to cover. First, we'll unpack why this frenzy is even happening now. Then we'll do a quick refresher on what an IPO actually is. After that, we get to the fun part, how you, the everyday investor, can actually get in on the action. And then the really crucial part, we'll talk about how to invest smartly and try to avoid the hype-fueled froth. Okay, first up, why is this happening now? Well, after the market really cooled off after 2021, there's this new feeling of optimism in the economy, and it's pushing a lot of private companies to finally say, okay, let's do it. Let's go public. It really feels like the floodgates are finally opening back up. The numbers on this slide really paint a picture. Just look at that peak back in 2021. And then boom, the market goes into a deep freeze in 2022 and 2023. But now, look at that rebound. We're seeing a huge comeback in 2025 with 153 IPOs already raising $29 billion. And the word on the street is there are dozens more waiting in the wings. So what's fueling all this optimism? Well, a big piece of the puzzle is the Federal Reserve. When interest rates start to come down, money gets cheaper to borrow, and it starts to flow more freely. That makes investors feel a little bit braver, more willing to move their cash into riskier, high-growth things. And that's exactly the sandbox that brand new public companies play in. Okay, so we're talking a lot about IPOs, but let's take a step back. To really get what the opportunity and the risk is, we need to pull back the curtain a little bit. So what actually happens when a company decides to go public? Let's break down what's going on behind the scenes. At its core, it's pretty simple. An IPO is just the moment a company goes from being private to being public. It transitions from being owned by a handful of founders and early investors to being owned by, well, pretty much anyone, including you, who wants to buy a piece of the pie on the stock market. Think of the traditional IPO process like a carefully planned exclusive party. First, there's the roadshow, where the company tries to get big money investors excited. Then the investment banks, the bouncers of this whole world, if you will, set the price. Then they hand out the first shares to their best clients. And only after all that does the stock finally hit the market where the rest of us can get in. And this quote from the Barron's piece just hits the nail on the head. For the longest time, the problem for regular investors wasn't even deciding if they wanted to buy an IPO. It was just getting a chance to buy in at that very first price. Basically, the game was rigged for the big guys from the start. But, and this is a big but, things are starting to change. That old exclusive club, the walls are starting to come down, and it's creating new ways for regular people on Main Street to get involved in some of Wall Street's biggest events. So what's the big shift? It's all about access. For decades, getting those ground floor IPO shares was a privilege. You had to have a huge account at a big bank. But now you've got this new wave of brokerages that are basically kicking down the door and demanding a seat at the table for their customers, for you. You've got platforms like Robinhood and Moomoo really leading this charge, making it easier to get in. Even the big guys like Fidelity and Schwab are rolling out programs. And what's really cool is that some companies, like the crypto exchanges, Bullish and Gemini, are telling their banks, hey, you need to set aside a chunk of these shares for our actual customers, our superfans. All right, so the door's open, you can get in on the action, but, and this is important, with all this hype, it is so easy to get burned. The excitement around a hot IPO can be intense, and it can be dangerous. So let's talk about how to be smart about it. This is the big question, right? That FOMO, the fear of missing out, it's real. It's powerful, especially when you see a stock double in a single day. But chasing that hype isn't investing, it's gambling. So how do you spot a real opportunity versus just risky speculation? It's so easy to get blinded by those huge day one headlines, right?
But what happens after the party's over? Well, if you look at the last 10 years, a fund that just holds a bunch of recent IPOs has actually done worse than the overall stock market. So even with those big individual winners, the reality for the whole group is a little more sober. And that trend doesn't stop after the first day either. Look at this. This data shows that on average, a newly public company actually lags behind its own industry over the next 3 years. A lot of them just struggle to keep up once they're in the big leagues. Okay, so what can you, as an investor, actually look for? How do you separate the good from the bad? Well, the analysis points to a few key things. First off, does the company actually make money? Profitable ones tend to do way better. Second, check the price tag, the valuation. Some of these are priced for perfection and then some. Third, keep an eye on something called the lockup period. That's when early insiders can finally sell their shares, and it can cause a big dip. And last, look at the float. If there aren't many shares available to the public, the price can swing like crazy. Which kind of brings us full circle to the big lingering question here. The gates are definitely opening up. Individual investors have more access than ever before. But with the big banks still controlling the price and who gets the first shares, you have to ask yourself, has the game really changed for the better for small investors, or is it just a bigger playground with the same old rules tilted in favor of Wall Street? Something to think about.